Welcome, everyone, and thanks for joining today's webinar, Unlocking Institutional Bitcoin Yield. I'm Elena Giralt, Director of Product Marketing at Stacks Labs.
And I'm Myles Jackson, Sales Director for Staking at Fireblocks.
In this presentation, we'll cover four things. We're going to start with an overview of the Bitcoin yield market today. Then we'll cover top yield opportunities, and we'll preview an exciting product launching later this summer, self-custodial Bitcoin-denominated yield. And finally, we'll do a walkthrough of how you can access all of these products with the latest Stacks integration on Fireblocks.
Before we dive in, a quick disclaimer. Everything you'll hear today is purely informational and does not constitute financial, legal, or tax advice. And since we'll cover forward-looking statements like target yields and launch timelines, please consult with your own advisors and do your own research on any of the products or opportunities covered in this presentation. Now let's dive in.
Starting with an overview of the Bitcoin yield landscape. There's about $200 billion worth of Bitcoin held by institutions and businesses just like you, and almost none of it is earning yield. But Bitcoin as an asset class has established its legitimacy through ETFs, corporate treasuries, and even at the federal policy level. Almost none of that Bitcoin capital is being put to work, especially when you compare it to other major ecosystems like Ethereum and Solana. If you just look at staking as a category, across almost every staking protocol combined, well under 1% of Bitcoin supply earns yield today, versus 30% for ETH and over 60% in Sol. For Ethereum and Solana, staking was so critically important because it laid the foundation for a larger DeFi ecosystem built on top of it. And that includes things like lending, decentralized exchanges, and vaults. Now, let's zoom in on the 1% of Bitcoin that is actually earning yield today. How is it doing that, and what are the trade-offs?
So there are several established ways a Bitcoin holder can earn yield today. These are the three of the following largest. First, you have your custodial lenders who hold roughly 4 to 5 billion in Bitcoin-backed loans. Major players here are names you've most likely heard of: Nexo, Coinbase, Leadin. And then in DeFi, there's 2 to 3 billion of wrapped Bitcoin that's actually deployed and earning, but it's worth noting that around 14 billion has been wrapped in total. This kind of illustrates the point that even for DeFi-ready Bitcoin, the vast majority of wrapped BTC earns no Bitcoin-denominated yield. Most of it is either idle or posted as collateral to borrow stablecoins against. And then lastly, there's Bitcoin staking, a relatively new category with players like Babylon and Core, and this accounts for a little bit over 3 billion. Each of these models has a critical trade-off. On the custodial lending side, there's counterparty risk. A notable example here is when Celsius froze withdrawals and went bankrupt, owing about $4.7 billion to its users. For wrapped Bitcoin, there's bridge risk. The wrapper itself is the vulnerability. 2026 has proved this across multiple examples, with around $329 million lost across bridge hacks so far this year. And then finally, with self-custodial lending like Babylon and Core, self-custodial yield products have undeniable product market fit, don't get me wrong. They get the custody part right. However, these products pay you in the network's own token, which can be volatile and decrease in value over time. So your yield can be underwater in terms of the Bitcoin that you actually have staked.
So how do we summarize the state of the Bitcoin yield market today? Bitcoin is the largest pool of idle capital in crypto, and yet no one has solved native BTC yield for institutions at scale. There is clear demand for native Bitcoin yield products, but a critical gap that's keeping 99% of Bitcoin on the sidelines. And namely is that Bitcoiners want to keep custody of their BTC and earn in BTC. And that's a critical gap that we are tackling here at Stacks. Stacks is the leading ecosystem for Bitcoin native finance. And thanks to the Fireblocks Stacks integration, Stacks clients can now put their Bitcoin to work using infrastructure they already trust. Stacks has an active DeFi ecosystem, which we'll hear more about shortly, a proven track record of distributing over 4,200 Bitcoin since 2021 through its native consensus mechanism, and a top-tier stablecoin integration through Circle, bringing unified dollar liquidity to Bitcoin. Whatever you want to do with your Bitcoin capital, Whether you want to trade it, earn on it, borrow against it, or lend it, you can now do that through these 4 products, all available within your Fireblocks workflow. Take BitFlow, for example. BitFlow brings you a Bitcoin native trading platform, the first institutional grade market maker purpose-built for Bitcoin. Here, liquidity providers can earn from trading fees. On Zest, you can earn up to 1.5% APY through their decentralized lending hub. On Hermetica, you can earn 3.6% APY through their yield-bearing vaults. And lastly, Granite lets you borrow against your Bitcoin with soft liquidations and no rehypothecation. No other ecosystem has the complete financial stack purpose-built for Bitcoin, enabling you to trade, earn, borrow, and lend. And you don't have to take our word for it. These are institutional strategies backed by some of the world's most prominent Bitcoiners. Take Hermetica, for example. Hermetica has an HBTC vault, which is a Bitcoin-denominated vault. It was also the first DeFi integration for Stretch, the strategy perpetual preferred stock. Michael Saylor highlighted this product on stage at Bitcoin 2026. You can also look at Zest, for example. Zest raised a $3.5 million seed round led by Draper Associates with Binance Labs and others. They have over 41,000 users, over 800 BTC in TVL, and they're shipping self-custodial Bitcoin collateral vaults later this year. As Draper himself put it, I don't want to just hold my Bitcoin, I want to put it to use. And more recently, we have UTXO, the asset management arm of Nakamoto, that announced its participation in Bitcoin staking on Stacks. Let me tell you about Bitcoin staking on Stacks. Bitcoin staking on Stacks is launching later this summer, and it's a product we're extremely excited about. It's the only product that offers self-custodial Bitcoin-denominated yield, so your BTC never leaves your control. We looked at every way to earn yield on Bitcoin today and pulled out the 3 things that are keeping institutions on the sidelines: giving up custody, getting your rewards diluted in a depreciating token, and unpredictable yield. Bitcoin staking was built to solve all 3 of these things at once. It's 100% self-custodial, the yield is paid in Bitcoin, and the yield is targeting 3% APY over the course of the bonding period. And it works in 4 simple steps. And again, for each of these steps, remember, Bitcoin never leaves your wallet. Step 1, you want to pair your Bitcoin position with a corresponding STX allocation. The STX portion is about 5% of the value of the BTC you want to earn yield on. The STX is how you reserve your spot in the staking capacity for a given period. Think of it as your allocation guarantee. Step 2, you're going to lock both of the assets. Your BTC is time locked on Bitcoin's base layer, where it stays in your own wallet enforced by Bitcoin itself. No bridge, no custodian, no wrapper. The STX is locked on Stacks for the matching bond period. Step 3, earn Bitcoin yield. It is that simple. The yield is paid out weekly in Bitcoin straight to your L1 address, targeting 3% APY over the course of the period that you have your assets staked. And step 4, unlock and repeat. When the time lock expires, both your BTC and your STX allocations are fully spendable again. And if you need to get out early, there's an early exit option for your Bitcoin, so your principal is never stranded. You might ask, where does the yield come from? The yield comes from Stacks' unique consensus mechanism, proof of transfer. Stacks miners commit real Bitcoin every 10 minutes to compete for Stacks block rewards. That BTC is distributed to all Bitcoin staking participants. The yield comes from miner activities, and every distribution is recorded on Bitcoin and independently verifiable. The system has a 5-year proven track record, having distributed over 4,200 Bitcoin since 2021.
To get a better sense of how this works in practice, let's bring this conversation into the real world and look at 2 different personas. Imagine you're a family office with a conservative investment mandate. You got in early on Bitcoin, and now you hold over 5,000 BTC. Your mandate is simple: earn yield, but the non-negotiable comes first: never lose the Bitcoin, which means strict policies on custody. You've looked at every L2, Babylon, Solve, Lombard, but until now, you couldn't find a product with sustainable yield. The biggest pain point for you, like I mentioned, is custody. BTC can never leave your control, And then it's also compounded by unsustainable yield. Here's why Bitcoin staking is a fit for you. BTC stays time locked in your own wallet, and the Bitcoin denominated yield pays out a steady 3% APY for the direct bond. Now imagine an innovative Bitcoin treasury company. They hold BTC on the balance sheet and are under pressure to make it productive. They're open to DeFi, but only after a heavy due diligence process. They prefer Bitcoin only or Bitcoin centric thesis. The pain point here is that yield is not in BTC. They want deeper Bitcoin native DeFi exposure than what a single staking product can provide. Overall, the goal is a clean Bitcoin denominated return that beats what they're getting today, plus room to layer in other DeFi strategies. Bitcoin staking is a fit for the treasury company because it's self-custodial, BTC denominated yield as an anchor position with a quantifiable risk surface that clears their diligence bar. Beyond staking, they have options: liquid staking via Zest, yield vaults, and a combination of strategies, so their returns can grow past that initial buy. As you can see, Bitcoin staking is a fit for multiple personas, whatever your mandate is. Let's dive into the numbers and take a look at a 12-month position. Say you stake 100 million of Bitcoin. You pair it with 5 million of STX. That's about 5% of the allocation piece. And that pairing guarantees your allocation in the bond period. You hold that position for a year, so that's 2 back-to-back bonding periods. At our 3% target, that's about 37.5 BTC in yield over the year, roughly $3 million to you, paid to you in Bitcoin. The only new risk you're taking on is the price exposure of your paired STX. The BTC yield needs to be large enough to absorb any STX downside in order for this to make sense. Basically said another way, stacks could fall 60% against Bitcoin before you even hit the break-even point.
Bitcoin staking is launching later this summer with limited capacity. If you are interested in learning more, visit the Bitcoin Staking Resource Hub, which we will link in the chat below.
Now let's switch to the product walkthrough, starting from inside the Fireblocks console through to a Bitcoin native product and the position and yield view.
Welcome to the Fireblocks Stacks app. Let's get set up. First, your Fireblocks credentials. I'll paste my API key or generate a signing request right here from starting fresh. It's validated and stored safely in the system keychain. Then the optional hero key for stacks. Feel free to grab, and it gives you much better rate limits. Then we're in. This is every Vault account with stacks enabled. Balance is live. Open any account for the full picture. The token dropdown breaks down everything it holds: stacks, USDC, SBTC. And then here is the stacks address and the matching Bitcoin rewards address. Both are one click to copy. And scrolling on gives you the rest of the account's details. Transaction history shows every transfer and contract call on this account, and any record links straight out to the Stacks Explorer so you can verify it on-chain yourself. Back to the Stacks app. Let's send some funds. Create transfer. I pick a destination, paste an address, or choose another vault from the dropdown. Select a token, set the amount, and approve. The actual signing happens through the Fireblocks workspace per your account policies. And then once it's out, we can follow it straight to the Explorer. Back to all accounts. Let's open Slava's vault. Notice there's no USDC here yet. Now back on the main account, a custom transfer token can be created. I choose USDC, and this time pick Slava right from the vault dropdown. No address to paste. Set the amount, review, and approve through Fireblocks. The transfer shows as processing while it validates, and one click takes us to the Explorer to watch it confirm. And over in Slava's account, There's the USDC, landed in red. That covers moving funds. Now the fun part. Back to the overview and into DeFi and staking. This is where the app's built-in browser lets your vault connect to Stacks native apps directly. No extension, no seed phrase. Here's the catalog. DeFi protocols on one side, non-custodial stacking pools on the other. Let's open a DeFi app. I'll open Alex, a DeFi exchange on Stacks, similar to Bitflow, where you can trade different tokens. We'll use it to demo a swap. It loads right inside the app. When I connect my wallet, my Fireblocks vault account shows up as the options. The vault itself is the connected wallet. Now a swap. Choose the token I'm trading from, the one I want in return, and an amount. Alex prices the route, I confirm, and because the wallet is my vault, it routes straight through Fireblocks in the same signing flow. It shows as confirming, and the Explorer link lets us verify the trade settled on-chain, secured by Bitcoin through Stacks. And back in the app, Slava's account and history already reflect everything we just did. Transfers, custom tokens, and a whole DeFi ecosystem, all driven from your Fireblocks vault, all secured by raw signing. That's Stacks on Fireblocks. Thank you.
Well, there you have it. We've covered an overview of the Bitcoin yield market, top yield opportunities available today, as well as a preview of Bitcoin staking, the self-custodial Bitcoin-denominated yield product launching later this summer. And finally, a walkthrough of the latest Stacks integration on Fireblocks. Here's what you can do next to get started with Bitcoin native finance on Stack. As a client of Fireblocks, be sure to have the app downloaded. Instructions are in the Fireblocks Help Center. Visit the Bitcoin Staking Resource Hub. And lastly, book a follow-up call to talk with a specialist about different opportunities to earn institutional Bitcoin yield today.
Thank you.
Thank you.